It is transcribing. Okay, good. Yeah, one person coming in.
Yeah, I let Dan.
All right. Since we have a couple new people here, should we just go around the room real quick and we'll identify ourselves as commission members and members of the public? You want to just start around and
Woody Kennedy, member of the public. Ryan Hill, member of the public.
all right.
Brandon Garrod, I am the Attorney General designee on the commission.
Jimmy Karras, I'm here for the state treasury.
Oh, great.
Amelia Galderia, bank commissioner, my person on the committees over there.
I'm Mark Gordon, state rep, but also member of the public today.
I'm Matt Whitlock, member of the public and presenting.
And Keith Adams, I'm the chair of the Stable Commission.
Seth Thornburg, I'm the academic appointee on the commission.
Mike Ranty, the banking commissioners designate on that commission.
All right, and then we'll go around online. We have Jim Kish. You want to go next? Then
Yeah, Jim Kish, member of the commission.
Katie
Katie?
Taylor, member of the commission, the secretary's designee.
And then we have Dan Nunez. Dan, are you there?
Hey Keith, yep, Dan Nunez Cohen, member of the commission.
I got everybody. All right, so quickly, we'll approve the minutes from our February meeting. Has everyone had a chance to look at those? I'm not printing those out. They're all available online. February 14th minutes. I'll briefly share my screen just so we know what we're looking at.
Click that one and then minimize the camera. Yeah.
Those are all mine. All right, so if you want to get to these minutes, it's the homepage. Scroll down for the meetings. This is today's meeting. And then minutes, that links to the minutes. All right. Again, this is AI summary with a few spelling corrections. It's basically what happened verbatim summarized. So any changes to the minutes? We do a motion to approve. 1 second.
I'll second that.
Okay, I'll make the motion.
You can
All
make the
right.
motion. Okay.
All right, and so all in favor of approving the January minutes, say aye.
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 Any opposed? Sorry, didn't wait for online. Any opposed? All right, moved unanimously. Get that out of the way. I guess if we're gonna have two presentations today, one's about a network called the Canton Network that the banking industry seems to be converging on, which is kind of interesting. And another charge of the commission is tokenized real world assets. Stable tokens are sort of a version of that, but it's a broader category. And we're gonna have Matt Whitlock. He has a project to tokenize real estate. So he's gonna tell us how he's doing that, any hurdles he might have. Any comment from the public before we get started from what you're looking to get out of today's meeting, or if you have suggestions or criticisms, anything from the public? All right, let's make it an opportunity.
What the new treasury, is there anything you guys are looking for?
Yeah, we're looking to get, and we apologize, I apologize for you not having a seat at this commission. So I thank you for.
Yeah, no, I think, I attended the last meeting just online, just trying to stay aware of what's going on. We've met with several firms, through introductions. I'm the director of the abandoned property division, so I'm kind of looking at it through that lens, but just where Treasurer Mazzapelli isn't able to be here today, just wanted to make sure that we
Have it covered. All right, any other comments from the members or anybody online? All right, so let's get right into it. So we have, Julie, remind me of your title. You're,
No problem. I'm the Director of Policy and Government Affairs at Digital Asset.
all right, so I'll turn it over to you and just, you can give your introduction however you see fit.
Wonderful. Let me just kick this off. One of the challenges of sharing my screen is that I can't see you. So happy to have questions at the end, but if you all also want to interject at any point, and ask questions. I'm happy to answer questions and make this as interactive as useful for all of you. So first, just a brief introduction as to who I am and what the company, where I come from. As we mentioned, I'm the Director of Policy and Government Affairs for Digital Asset. Digital Asset Holdings is a company that's been around for about 10 years, and we are the creators of the Canton Network. I'll get into a lot more detail on what the Canton Network is. I personally am at Digital Asset after about 10 years at the U.S. Treasury Department, where I did a lot of work on anti-money laundering, sanctions policy, and kind of the convergence of those two issues and digital assets. So I mentioned that just because I very much come from like a regulatory policymaking background, and happy to kind of provide any information throughout this presentation on those issues. But you'll also hear like I hearken back to some of those issues as they're still top of mind for me. So give a brief overview on tokenization, diving into kind of the architecture and what this Canton Network cloud and this layer 1 blockchain. Just a little bit on just how we think about tokenization, but we really think about tokenization as creating an on-chain token. And the critical part for us is that it represents the same rights and legal obligations and ownership as the underlying physical or digital assets. And I think as we're going to hear today, a lot of different assets can be tokenized. So while I really focus on money, equities, bonds, cryptocurrencies, we'll hear, I think this afternoon, people who are focusing on real estate tokenization. But when we as a company think about tokenization and how to explain it, we really think about it from a perspective of using the blockchain for books and records. So originally from a financial market infrastructure perspective, books and records for capital markets were kept on paper. They then moved to an electronic format, which is what much of the market uses now. And the goal of really tokenizing assets, especially securities, other commodities, is to use the blockchain as the books and records. And one of the things that we often think about as a company is trying to just explain why everybody is excited about tokenization. Like, what do you get? What's the benefit of using the blockchain for your books and records? And one of the critical reasons is for settlement time. So from a payments perspective or from an equities perspective, settlement takes time. Domestic payments can take 2 to 3 days. Cross-border payments can take weeks. When we talk about like the dividends landscape, it can take a month for those assets to actually settle. And that matters not only for large corporations, but also for retail consumers, because essentially during that period, you don't have the access to your cash and you're not collecting interest. So from a retail perspective, you can't use that money until it actually settles. But from a corporation's perspective, if you're missing out on a month of interest for a large amount of money, that interest truly, that's a significant amount that you are missing out from an interest accrual perspective. So shortening that settlement time has a real world impact, not only for large corporations, but also for retail customers. So given those opportunities of trying to bring capital markets and tokens on chain, I think a critical question that we as a company have really thought about is, okay, but why have we seen it take a little bit of time for traditional financial institutions to come on chain? What do those barriers look like? And kind of that's the philosophy of how the Canton Network was created and the Canton blockchain. So first, while it's wonderful that tokenization can advance record keeping and settlement speeds, traditional financial institutions are very hesitant to put all of their books and records on a public blockchain for public display, because fundamentally it's not really acceptable for their transactions to be public knowledge. From a balance sheet perspective, they don't want to reveal their investments, their trades, their payments, salary payments. And so there's a real need for privacy that exists for traditional financial institutions that other blockchains just don't traditionally provide. Another challenge that we've seen for migrating capital markets on chain is the limitations on a lot of blockchains for throughput and scalability. So when we're talking about capital markets, we're talking not about billions of dollars, we're talking about trillions and quadrillions of dollars. And so you really need to be able to move assets at scale. And, you know, one example that we come back to in some of our literature is back in 2017, there was this very popular app that was launched on the Ethereum blockchain called CryptoKitties, which was a blockchain game with non-fungible tokens. The app took off, and essentially it very quickly exceeded 12% of all the network transactions on Ethereum. And the result of that is that other apps on Ethereum experienced delays and latencies, and the transaction fees went up. That's just not feasible from a capital markets perspective. That's just not reasonable for the ecosystem. So we really needed to think about how to make sure that a blockchain could scale and have extensive throughput. And last, another barrier that we spent a lot of time thinking about is an element of control. Financial institutions need to maintain some element of control for their legal and regulatory obligations. So, for example, if there's a staking transaction or fraudulent purposes, they need to be able to undo the transaction. At times, from a sanctions perspective, they need to be able to freeze an asset. They may need to be able to pause a transaction, ask for more information, and then decide, is this suspicious? Do they have a filing obligation from an anti-money laundering perspective? So they need to maintain some amount of control on their own transactions and books and records that other layer one blockchains just don't really provide them the opportunity to do so. So those are some of the barriers that we identified, but I think the flip side is, okay, given those barriers, like what's the point of putting markets on chain and what do you get from it? So this slide just lays out a little bit of our vision that goes behind like the architecture of the blockchain. First is to kind of make sure that there's an on-chain capital market ecosystem that enables privacy. Second, we want to enable real-time trading and settlement. Again, really shortening that settlement time from days and weeks and months to instant. Another one is to make sure that you can enable 24/7 trading, not being really tied to market hours, weekends, making sure that trading can be continuous. So those are some of the goals that we want to achieve by bringing capital markets on chain. And so through that, created the Canton Network. And the Canton Network is a privacy-enabled public blockchain. It's really built for regulated financial institutions. And it's also built for crypto, but again, it's really seeking to solve those problems and challenges that regulated financial institutions had with coming on chain. So the baseline of Canton is that it's public and permissionless. Anyone can propose, anyone can participate, anyone can operate infrastructure in line with the protocol and its governance. But at the same time, individual applications, such as financial institutions, can define their own access and disclosure policy. So the way that I often think about it is each financial institution almost maintains its own like sub-compartments of the blockchain. So financial institution A can decide who can see what's going on in their own books and records, and financial institution B can do the same thing, but the Canton Network enables them to kind of very easily transact between the two subnets, which is unique, and kind of I can explain if there are questions on what's really unique about how this was developed. Kind of two examples that this promotes because of the way that it's set up is that you can have like a gated money market fund where they have know your customer obligations, anti-money laundering requirements. They can be on the Canton Network, and so can an open access developer tool where anybody can access it, anybody can use it. There's an ability for each of them to have their own privacy and governance controls on the Canton Network. The network is governed by the Canton Foundation, which is really responsible for driving activity on the network. And as I continue, I'll kind of explain what that looks like. So a little bit.
Julie,
Yeah. Yes.
Sorry to interrupt you. Your sound keeps going in and out. We can hear you, but it's kind of quiet at times. I don't know if it's a microphone or.
Okay. I'm going to bring the computer closer to me and hopefully this helps. Has this helped a little bit?
Yes, it does. Thank you.
Thank you for letting me know. I'll speak louder and I'll bring it closer. So this picture just provides a little bit on the architecture of Canton. So what you kind of see here is these pink circles are individual applications, and you could think of them as large financial institutions. So each of them have their own little segment of the blockchain, and they have their own validators. So while anybody could be a validator on the network, institutions can also choose if they only want certain validators to be responsible for validating transactions on their sub part of the network. But then all of these pink kind of circles are connected through what we call the global synchronizer. And the global synchronizer is responsible for validating and coordinating transactions across the network. And the individuals responsible for that are called super validators. Right now, we have about 39 validators. Broadridge, DRW, Circle, TRM Labs, a mix of traditional financial institutions and companies that are more on the crypto native side. And in order to be a super validator, you have to be voted onto the network. So you have to submit a proposal and explain how you're going to add value to the network, what utility you're going to bring, how you're going to help build the network. And then if 2/3 of the super validators agree, then you will then be a super validator. I think we've covered most of this, so let me move forward. I want to spend a brief moment talking about privacy because I think that from a digital asset perspective, a lot of different companies talk about privacy very differently, and I want to really be clear about what it means for Canton to enable privacy. For us to enable privacy, what it means is that each financial institution, each app on the blockchain can see its own information and it can choose what to share with others, but that information is still available. So if law enforcement wants information, they don't just go to a blockchain that's public, they go back to the financial institution, which is how things work right now. Now, transactions between individual apps or financial institutions can be public or they can be private, just depending on how things are kind of governed. But what you can see in this square to the right is like Alice has visibility into her transactions. Bob has visibility into his transactions, but they only have co-visibility into transactions that they are both involved in. So the data is shared on a need-to-know basis. And again, this is really built to make sure that financial institutions can comply with their SEC, CFTC obligations on books and records. They can comply with their anti-money laundering obligations. They can comply with their sanctions obligations. So really building something that works for the regulations that we currently have in place. And I think I've previously mentioned this, but each app that is on the Canton network can really operate independently and again, decide what data to reveal. And this really just provides a couple examples of some of the networks, some of the apps that are already on our network. So we have Broadridge, which is doing trillions of dollars a month in repo transactions, and Circle, which is providing 24/7 stablecoin liquidity. So again, you see a mix of companies that are really from the traditional financial space, but also ones who are more focused in the digital asset ecosystem. So now moving to the Canton ecosystem, I just want to talk a little bit about who's on the Canton network and what we're doing. First of all, the vision of the Canton network, as I've previously mentioned, is to bring capital markets on chain. But we didn't want to only target traditional financial institutions. We also wanted to target crypto. And the reason we want both is my CEO recently gave an example of right now as a retail user, if you have $100,000 worth of Apple stock and you need $20,000 to renovate your house, today a retail user can't really pledge that equity as collateral. So you can sell your stock, you pay taxes on it, and then you can use the money. but there isn't really a mechanism right now for you to use that equity as collateral. But crypto's done a lot to enable the ability of retail users to do different and new things with tokens. And so, for example, you could pledge assets on an Aave and then get USDC stablecoin from it. So we really want to enable partnerships between crypto and traditional financial institution and allow them to work with each other when they want to. But we've also really, especially in the last year, made a lot of progress moving traditional financial institutions onto blockchain. And so one recent example that came out in December is that the DTCC announced that they're going to be partnering with the Canton Network and with Digital Asset to bring DTC custodied US Treasuries onto the blockchain. And this project will be a phased approach that's going to be done in coordination with the SEC. The SEC, and what I mean by coordination is the SEC issued a no action letter in December that would allow DTCC to tokenize a segment of assets to include US Treasuries, ETFs, and certain types of equities. And as part of that, there's a list of information that DTCC will need to report to the SEC, and all of this is public. And DTCC chose the Canton Network as the first blockchain to tokenize US Treasuries and put them on chain. And one of the reasons that we think this happened is it's clearly because of the fact that the blockchain was built, again, to enable regulated financial institutions to come on chain and maintain that level of privacy and control that they need. We also currently have Broadridge working with the Canton Network and putting assets on chain. They're processing about $6 trillion worth of repo transactions on the Canton Network. So that's a brief overview of what we're doing. I want to pivot just for, I think, let me cover the coin and then I'll pivot to some of our underlying policy issues that I wanted to raise for you all today. The Canton coin is the utility coin on the network that's used to pay for transaction fees. And one of the ideas that crypto really talks about is trying to make sure that end users can own a piece of the infrastructure. But what we saw from other layer ones is that it wasn't always clear that the users of the technology were benefiting from the activity on the network. So the Canton coin is really developed with that in mind. When the chain was launched, we did a fair launch, which meant there was no pre-mining that occurred, there was no allocation to venture capital, and everybody who receives Canton coins are earned via their work. And it's really divided up where a portion goes to the applications, a portion goes to the infrastructure providers, meaning validators and super validators, and a portion goes to users. And the reason is because we really wanted to move this idea of driving real activity to the network, and that's how you get coins. So large financial institutions that are processing transactions on the Canton blockchain are going to be rewarded through receipt of Canton coin. And now I'm going to pivot a little bit to policy considerations. One of the things that I think we're really seeing across the tokenization ecosystem is this question of what does tokenization mean? How do you define it? And how do you distinguish between digital assets and tokenized real world assets? And a critical issue for digital asset that we always want to emphasize is that when we think about tokenizing assets, especially tokenizing traditional securities, tokenizing commodities, but we want to ensure that those tokenized assets are providing the same legal and economic rights as the underlying asset. And this is reflected in some of the recent SEC information that came out on securities, on tokenized securities, where they differentiated between tokenized securities and tokenized synthetic securities. And tokenized securities is that bucket that, again, provides the same legal and economic rights as the underlying assets. And the reason that matters is because that transparent and precise taxonomy is critical for making sure that investors know what they're investing in. So does that token give them the same rights as an electronic record of the underlying asset? And that's really like, of all of the things, and I'm happy to answer questions that we wanted to leave you with, it's this question of, as you know, the commission is thinking through how to provide clarity, what they want to do on tokenization. The most important thing from our perspective is making sure that there's some definitional precision so that consumers and investors have an understanding of what they actually have access to in a token. These slides have been distributed, and so there are a lot of additional resources here should you all have questions. But with that, I'm going to pause. I can stop sharing my slides if helpful, and I'm happy to answer any questions that you all have.
All right, thank you for that.
Yeah.
And I'm sure we'd have more questions as we go here. So your slides are on the meeting page on the portal, so we can go look at those. We'll just open it up to the room first. Any questions to start based on what we heard?
Yeah,
If you want to
thanks.
get dismissed, then you can see her.
Oh, yes. Thank you. All right.
Thanks for that presentation. I really enjoyed the distinction between digital assets and tokenized real world assets. And I wonder, I've been following the Clarity Act, and I know that it's kind of stalled right now. And some of the tension has been around offering rewards. So is your business model or models like this kind of contingent on Clarity permitting rewards, or by the virtue of this being about tokenized real world assets and not digital assets, does that make the rewards debate that's going on sort of irrelevant to this space?
Yeah, so as creators of a blockchain, I think the issue of rewards is not something that we have weighed in on. Our kind of business model would continue. What we're trying to do is take real world assets and bring them on chain. But I do, since you've opened up Clarity, I do want to note that one of the many reasons that we think it is important for Clarity to move forward, though, is because we do see that traditional financial institutions are waiting for that sort of statutory information that would come in Clarity. And there is also a provision in Clarity under 505D where it clearly states that you cannot misrepresent the asset, specifically the tokenized security. So a tokenized security needs to have the same legal rights and obligations as the underlying asset, and you cannot misrepresent that occurs. So there are elements of Clarity that we're clearly very closely following because we think it's important that investors and consumers understand what they get by holding a token. But we're less weighing in on that yield question that has been really all over the news. And sorry, by yield, I mean rewards, but call them both.
I guess I think of it like the old way of doing things was a signature was like your proof of ownership, and the new way of doing things is the token is your proof of ownership, right? Sort of like replacing this. Yeah.
And I think one of the reasons that it's important that it's clear, like people have an understanding of what they are owning is, first, if it's a traditional tokenized security, then the current securities laws and obligations and regulations apply. And the SEC has been really clear about that. But second, you want to make sure that assets are fungible. So if one tokenized security actually represents the underlying asset, but another represents something that's synthetic, it's a reference token, you don't get the same thing when you exchange them. So you also want to make sure that investors actually have an understanding of what are they swapping? What are they exchanging? Apple stock should be Apple stock, regardless of whether if it's tokenized, it should be the same Apple stock across the chain. If you have it representing different assets, it can cause market fragmentation, it can cause confusion. Investors don't know what they're investing in.
I just want to make one other comment before I go to the online for questions. The fact that the DTCC chose your platform, that's a big stamp of approval. And my question is, inside the DTCC, are you going to tokenize the securities that are controlled by the DTCC so you can trace ownership? Because I think there's an issue now where it all gets bundled together and it's all mixed up, and I don't completely understand all the inner workings of it, but be able to prove who actually owns an individual security, in contrast to how it is now, where it's just a big basket where everybody's stuff is kind of thrown in there. Is that what your network's going to do for the DTCC?
So I need to go back and check a little bit on like, I think what you're referring to is like an omnibus account versus what's actually like an individual account. But let me check a little bit on that. What I do have a more clear understanding of is like, look, the DTCC is going to first start with tokenizing US Treasuries, and then they're going to expand to other assets, but they are doing that business. So like that, but I can get more information about what that exactly looks like and how that's flowing down, like the benefit to the actual financial institutions that are clearing through DTCC.
So they're using your platform, but you're not sure exactly what their implementation, they decided your platform was the right one, but their specific implementation is, yeah, you have to find it more information.
I just don't have it off the top of my head, but I'm confident that some of my colleagues do, and I can come back to you on that.
All right, great, thank you. Anybody online?
Yeah, Jim Kish here. Julie, great presentation. Appreciated it. I'm a bank CEO, so just for context. So you talked about tokenized assets. How about tokenized deposits? I know they're assets as well. Are you how are you dabbling in that space?
So I think like many, this is an expanding space. I think we saw JPMC just announced that they were going to be putting their coin on the Canton network. Right now, I think a lot of the underlying cash for some of the transactions is in stablecoins, just because if they've been the first on chain. But we envision a world where you also have tokenized deposits that are also providing that cash leg. But I think that's a critical question. Like, what's the cash leg in some of these trades? Is it tokenized deposits? Is it stable coins? We're agnostic to that, but we are working with multiple other financial institutions to, again, help them move their assets on chain.
Excellent. I think it's you have a fascinating approach where you have ledgers that are private and then you have ledgers that are public. That's interesting. So I can imagine building a bank building on your chain, and you could have tokenized deposits that are private, and those transactions remain private. But then if you want to move stablecoin between parties, you could also facilitate that on one network. So am I following that correctly?
That is exactly it.
Okay.
And the other thing is that because it enables that interoperability between the financial institutions on one chain, and again, like it reduces some of that settlement risk, the FX risks that we've seen when you're going cross-border. But definitely it is meant to enable those financial institutions to interact with each other, not just on their own networks.
Okay. Thank you so much. Appreciate it.
Of course.
Hi, Julie.
Yeah.
I do. Hi, Julie. My name is Katie Taylor. I do have a question. I agree with Jim. Your presentation was very interesting. You mentioned briefly the settlement periods being a lot shorter, and I agree that there are, I hear the benefits, but that can be, from a regulator perspective, sometimes a concerning space where money can move very quickly. Do you have any examples of safeguards or maybe even disclosures that an investor might be able to have to really understand the space regard to the fast settlement times?
Yeah. So I think there are two things that I would point to. First, each institution can create their permissions in their own way, which I think really enables to put in safeguards exactly in line with what you're saying. Like they need to be able to reverse a transaction. They need to be able to pause if they need more information. I think that's, one side of it. The other is we saw when the SEC put out the no action letter to the DTCC, they also very clearly stipulated, like you need to make sure that customers understand that these will be tokenized assets. Right. So while we're creators of a blockchain, we are not going to mandate that, what institutions are doing. I would say we very much support that there should be very clear information that investors and companies have on what it means that assets are tokenized, what it means that the settlement speed changes. And people should know how their assets are moving. Like that should not be an unknown. So we're very supportive of that. And we did see it from the SEC no action letter.
Thank you.
I have one other question. Yeah, just thinking about the New Hampshire intersection here, to what extent would this be something that municipal governments might be interested in for maintaining their records? For example, property records. Is this technology suitable for that, or is this really a banking infrastructure product?
No, I think that it is anything that you can tokenize can be put on the Canton blockchain. There's no reason that it is not suitable for others. You could put other sorts of records on chain. Again, the positive that you get is where you can create some sort of privacy depending on what you want. If you want everything public, you can have that. If you want to permission some of that access, you can have that as well. So I'm going to check if we have other real estate projects that have come on. Just don't have the answer off the top of my head. I'm looking at like just some of our apps that we have that
I'd be
huge
curious if you
circle.
have anything that intersects with a property or anything that municipal or state governments either do, or if you have any, clients or people on the space just thinking about how New Hampshire could also use the product.
Let me take that back just because I don't want to, or let me take that back and just do a little bit of digging, but happy from a state municipal perspective and also anything on like real estate.
But it could be property deeds and car titles and that kind of thing, right? Just all that
Completely.
good. You get a non-fungible token for your particular car, and it's a record with this stuff. This probably. Any other questions in the room? All right, I have a couple. So about open and permissionless, is your blockchain interoperable with other blockchains? And I imagine the institutions kind of set the rules on how their individual tokens are interoperable. But if you could, can you swap, like say Ether for Canton and back and forth? And does the token go with that?
So what we've seen is there are bridges that, are being built. And I think we saw this in the case of Circle in USDC. So USDC is natively issued on certain chains. And given the privacy that exists on Canton, USDC created like a unique, their own controlled bridge in order to move USDC onto the Canton network. So you can move between blockchains, but the same challenges exist here as they do elsewhere, where depending on the type of asset, it may need a wrapper, it may need to go through a bridge. Like those same challenges exist if you're trying to move across different blockchains.
But it's not a walled garden as a total network.
It's not a walled garden.
And then, because the space that you guys occupy is very interesting, there are some other projects, and I don't know enough about all three of your projects. I'm going to mention the Midnight Network, which I think came out of Cardano, and then there's something called the Aztec Network it's a layer 2 on Ethereum. I don't know if you are familiar with either of those projects, but they have this practical privacy, they call it, I think, on the Midnight Network, where you can expose enough information to where the government can say, okay, you're approved or you're within the regulatory boundaries, but you also get to preserve the rest of your privacy. You're not fully naked on a blockchain like you are on some of these other ones. I don't know if you could speak to that, or maybe we could talk about that offline, but they seem to be like near competitors in the space with you, and they're both pretty recent.
So I think part of it's a philosophy. So we could kind of divide it into two. One is what we've seen is this idea when you have a layer 1 blockchain, everybody can see everything. So then what we've seen is companies that are using layer 2s, which is kind of like built on top. So the challenge that we see is that within the layer 2, you don't have privacy. So you could have a layer 2 that's built on top. You have multiple institutions using it, and there's no privacy within that layer 2. And then the interoperability we see between layer 2s is done through a bridge. And I think we've seen a variety of cyber incidents occur through bridges. Like there are just security incidents that we have seen that occur when bridges are used. And so it's just a different kind of way to transact where on the Canton network, it's all part of one larger network. When you have layer twos, there's more of a division between them. And then there's this idea of like limited forms of privacy, which are typically done using zero knowledge proofs. But I'm not sure if that is the technology that was used for one of the networks you talked about. But I think
they're
from
both.
there, okay. Again, we have seen incidents where there are some cybersecurity challenges in zero knowledge proofs. Like we just did not think that that technology is advanced enough for use, but also it doesn't always address the underlying needs for a regulator or a financial institution. So for example, if you are holding underlying assets for a stablecoin reserve, like really what you can understand is, are the assets there? Yes or no? But like, what does an audit look like? If there's a cybersecurity incident, can you still make sure that if the audit, if you are being told, yes, the reserves are there, can you verify that? Can cyber incidents happen that make that verification null? So those are some of the issues that we've seen in the ZKP like landscape. Also, kind of just to throw out one other challenge that we have seen is that if what you're being told from a regulatory perspective is yes or no, like what happens from a know your customer information? Like how can one financial institution verify the validity of information from another if all they're being told is yes or no? Like that doesn't always fulfill their customer identification program obligations. It doesn't always fulfill their sanctions obligations. It's very much like an attestation model, which is just not where the regulatory framework is, at least in the AML space right now. So I think that has likely caused challenges for financial institutions because they need to actually get the underlying information.
And your open source project, those are all like important things, right?
Yes, we are an open source project.
Any other questions? So I'd like to follow up with you at some point down the road, and I think I'm going to dig into your network a little more just to understand the full breadth of it, and ask some more nerdy questions. That's kind of
Actually, I got one.
you shoot. Yeah.
Are you guys seeing anything with community banks, or are they more the national banks that? Or the,
I don't think, we don't have any community banks that are super validators or part of the foundation right now. But I'm gonna take that back and see if we have any. I can't think of any community banks that I have seen that have engaged yet. I think it's something where it would be really, like we're financial institution agnostic. Like we want to be able to enable anybody to use the technology, but I can't think of them right now who have already accessed the network.
Could a state be a validator?
Sorry, what?
Could a state be a validator, and what would be involved in that? Just out of curiosity.
So anybody can apply to be a super validator. Oh, can a state be a validator? Yes, a state can be a validator if they have like the ability to validate transactions from a technological perspective. To be a super validator is where we require that you submit a proposal and then you need to have 2/3 approval by other super validators. And for those, the proposal is really like a question of, okay, what value are you going to be bringing to the network? And it's also to ensure that because those super validators are the ones validating transactions across multiple financial institutions and apps, really across the whole network, financial institutions want to understand that their validators and super validators meet certain eligibility. So for example, a financial institution will want to make sure that a super validator is not a sanctioned entity. So that's like one of the reasons why you have those 2/3 vote, because they have certain legal and regulatory obligations that they need to meet. So a state would not be a legal and regulatory challenge, but there is just a question of like, they would need to still go through that same approval process.
And then just one last question for me, what is involved with being a validator? You're running a node, a series of nodes, what kind of compute
you're running a
power,
node.
electricity? What's
You're-
required to run a node?
I'm happy to send you some of the like details from a technological perspective because we've
Yeah.
written that up. Happy to do that.
I'm just thinking like $100,000, $1 million, or, you know, like what's involved in, what's the scale of running a node? That's all I was asking.
I'm sorry, like I don't have it off the top of my head, but I'm happy to check. Yeah,
No problem. Just curious about that.
definitely.
Any other questions online or in the room?
Just not sure if the camera went off. Can you see anyone in the room other than me?
Just you.
Okay.
I think it's going
We're
back on.
Okay.
Not sure.
Back on.
There we go.
Yeah.
Sorry about that. Could New Hampshire community banks each have their own institution? I don't know exactly what you call it on the network, the pink circle. And
Yes.
could they, let's say, have their own stable token pool within their institution and then, or even tokenized deposits and then trade within each other within your network? To create like a larger liquidity pool?
Yeah.
Is that something that's
So-
feasible?
Yes, any financial institution can join and like use the blockchain, and then they would permission and develop their own governance, and then they could transact between them. If they wanted to launch their own token, similar, it's the same thing as JPMC putting the JPM coin is what they're calling it, and putting that on Canton. Any financial institution could do that as well. You could take a tokenized deposit, put it on chain. You could create like a tokenized deposit that is shared across multiple financial institutions. Like it's a question of how their like what their governance looks like and how what their token looks like. But from a technological perspective, definitely.
Okay.
So now you got me thinking. So
Yeah.
do you have, sorry, go ahead, Jim.
No, that's all right. No, I'm sorry. It got me thinking too. Please.
You go first.
Okay. Yeah, since you laid that out, Jim Kish here, so thinking about our bank is, our banks are the pink circles. I like that we're describing them in such, basic ways. And then around those were the little, I don't know what the color representation, but they were validators, but those were private. Those weren't the super validators. Those are the validators. So do the banks choose their validators? Is that the way that works? So we can make sure that none of it's going to get in the hands of a sanctioned party or somebody we are competition or something. But if we're going to go through that process, we have a kind of a menu of validators to select from, or how do we get just conceptually? I'm just trying to understand how that would work.
So you can choose what the governance looks like, and you could say that you only want validators X, Y, and Z that you choose. You could say you're going to open up to be for any validators. And so there's a process that you would go through as part of your figuring out your privacy and your own governance on your app. But it's precisely for those reasons, because a DeFi application is going to have a different requirement than a bank. And like we
Right.
fully recognize that. So
Right.
yes.
Very cool. Thank you.
And then my question along those lines, the financial institutions you have how they've shared it with the regulators or like auditors? Is it through them, through you guys, or you directly? Like, how's that been built?
So through like on the blockchain as part of your permissioning, you can give a regulator access to the information that's part of their own governance structure. And financial institutions will work out, and I think the DTCC is a great example. Like the no action letter from the SEC was granted to the DTCC. The DTCC separately chose to put their assets on the Canton network. And they're working through the company Digital Asset to like figure out what that looks like from a technological perspective. But the regulator is working with the regulated financial institution, which is not the Canton network or Digital Asset.
But does it make it easier on the regulator to regulate and more transparent for the public? To that first thing?
If If it is permissioned for the regulator to have full access, then they would have that, they have the full access. From a public perspective, I think it's equivalent to what things look like today in a traditional financial institution. I can't, as a public, see every transaction of any bank, which is different than what it looks like when I go look at blockchain analytics for like other layer ones. You're going to see more information than you would if you ran blockchain analytics on the Canton network or on the Canton blockchain.
How long do you see this on quarterly reports? The big submit.
I do not have a prediction for you.
Okay.
Yeah.
Smart answer. All right. I think we should probably keep going, but maybe we'll reel it in here. Julie, we want to thank you very much. It's a very unique project that you're working for, and we'll be in touch down the road and looking forward to meeting you in person one day.
Yeah, definitely. I have a few questions that I'll take back, and we'll kind of just get you something back in writing that you can share. And if there are other questions, resources that you all need, please reach out. And also happy to, if there are like more specific tech questions that I was not able to answer, happy to bring the right people to answer and get a little bit more of a tech deep dive, if that's what folks are looking for. So thank you all for inviting me today.
All right. Very good.
Thank you,
You're welcome
Julie.
to stick around. It's totally up to you.
I'm going to probably say goodbye and thank you, but I really appreciate it. And thanks so much.
All right. Thank you. That was interesting. I think that's going to be some homework for me. So we'll just go right into it. Do you want to discuss that at all? I mean, it seems like the sweet spot to some degree. It's not like doesn't make everybody happy, but it's sort of like a compromise middle as far as pure privacy and pure transparency.
Yeah, you know,
So-
I was going to say too, it strikes me, to your point there with this project, is it strikes me as it's got the kind of compliance rails of this private ledger and then the public side of things. So if we're looking, you know, kind of for a network that has the flexibility to do some things that are interesting, and you know, if we're going to go down a road with selecting a chain, if that's a direction that we're going to take, I think this is a kind of chain that could provide, you know, a lot of future opportunities as we want to explore them.
I thought it also, to the extent that it could provide additional services, that's useful if there's a chain that runs various state projects, and it could, you know, if it can do things, including a state stable token, but could also potentially be adapted to handle driver's licenses, things like that too. That's very useful, but has that, then you have like sort of one system, one training.
One token you have to use.
One token that you could potentially use and stay in the system without having to do wrapper. I did have a technical question that maybe others know better. I don't know if this is the right time for that.
You can ask, yeah, we'll see.
Well, I guess I just don't understand some of the technical differences, like zero knowledge proofs, ZK snarks, and whatever this technology is using. I mean, there's all these sort of cryptographic terms around revealed private and public information. And I didn't really understand how this project was fundamentally different than some of those other technologies I probably also don't know well enough.
So I assumed it was zero knowledge proof.
But they're using zero knowledge proof.
I assume that, but that's something I learned today that they're not using it, so I'll have to go and figure out. That's where our glossary comes in. I think it's on there. That'd be a good time to reference it. Let me share the screen so people not able to use my mouse, so I'm a little bubbling here. To do that, it disappears. Here we go. So yeah. So it's at the bottom here, there's a glossary. And I think if I search for zero, spell it right. Oh no. Layer zero, there it is. But these are really simplified definitions, you know, Google or chat would be able to tell you more, but
I wanted to, I'm sorry, please.
yeah, I was just gonna say, I don't know the mathematics behind it. It's like a trick of mathematics that you reveal that you know something without revealing the actual thing that you know. That's basically the short of it. And there's an example of that involves Where's Waldo, if you know the Where's Waldo cartoon. Trying to remember the example, but imagine a big wall-sized poster of a Where's Waldo, and there's millions of little people all over that wall. And you come along with a piece of cardboard, and the only thing cut out in the cardboard is where Waldo is, and you can put that on the wall and you can prove. And somehow you're not revealing information. I forget that part of it. So Google the Where's Waldo example of zero knowledge. But it's a trick of mathematics. And the idea is like you can reveal that you meet a certain qualification without like say, are you over 18? You can reveal, yes, I'm over 18 without revealing your age. Like that's a simple example. So it's like a test of truth.
Or without revealing like your street address. Like if you have to hand someone your driver's license, they learn your street address,
Right.
as well as proving that you're old enough to buy beer.
Right.
And a technology like this could theoretically allow retailers in New Hampshire to quickly and immediately verify whether someone's eligible to buy beer without the privacy issues that come with providing some type of issued ID.
Right. So that's a pretty deep subject. I'm still trying to get to the bottom of it. I'm not a mathematician. It's a very deep math behind it. Right. Anything else on that subject?
One thing she had mentioned, Jim Kish here, she had mentioned this, the zero knowledge proof. I think she referred, it's more of a Boolean, it's either true or false. So she began, I can look back at the transcript, but just a note is that, to know your customer and to know some details of who you're transacting with is important on the banking side. Because not only do we need to know to validate, but there has to be some sanctions checking to make sure that the party isn't sanctioned.
Yeah, I mean, there's some ways. So there is criticism of the AML KYC laws because it becomes a honeypot for everyone's private information at all the institutions that we deal with. A hacker gets in, steals the database, and now it's kind of meaningless because now everybody has your information, right? So there's I think the current system is not ideal. The purpose of stopping illicit finance or sanctions, tariffs, that's all well and good, but we're oversharing, in my opinion, we're oversharing too much information. We're putting it in insecure places, and then it can be hacked. And now, I'm trying to comply with the bank account by giving them all my information. But now all the hackers on the dark web have it because somebody hacked into their database, right? So the zero knowledge proof would prevent that from being possible. That piece of it. So we'll still explore that.
Yeah, I think it's great to rewrite conventions, particularly because those conventions have been in place for as long as computer and data processing and beyond, right? So it's certainly time for evolution.
Let's move on to the next one. So we have Matthew Whitlock. I know you used to live in where? I don't know where you live now.
Manchester.
Manchester. You're going to present on your tokenized real estate startup. I think I did the test token with you. That's how I learned about it. I do also want to recognize something interesting. Can I do this? So we're having a discussion around crypto ATMs in the Senate bill. And you might dispute this, but I think this is true. Matt is like a co-inventor of one of the very first Bitcoin ATMs, and that it was here in Manchester.
First intended for mass production.
First intended for mass. That's something. Okay. And that was in what year?
2013.
2013.
Yeah.
Yeah. So it's kind of interesting. History. All right, Matt. So I'm going to pull up your slides. You'll just tell me next slide, I think.
Sure.
And on the subject of zero knowledge proofs, I have a little example later on of how that is actually used in crypto to guarantee that, well, we'll get there.
All right. How do I do, full screen?
Okay.
I'm revealing all my private information right now. I need to see. Screen. All right, you'll just say next. And everyone online, can you see this?
Online. it was
Affirmative,
just
yeah.
like-
Or you can see it?
Yep.
All right, so we'll take it away, Matt, and the microphone is right there if you just shout in that direction.
All right. Well, hopefully everyone can hear me online. My name is Matt Whitlock. I'm a New Hampshire resident now. I've been here for 16 years and I'm a software engineer. My specialties in software are in distributed systems, cybersecurity, and cryptography, which is why I really got into Bitcoin early on, OG Bitcoiner. Like Keith mentioned, I was a co-inventor of the Lamassu Bitcoin machine back in 2013. I developed the software for the prototype that we demonstrated at the New Hampshire Liberty Forum that year. I was also the developer of the backend trade engine and the cold storage vault software for CoinFloor, which was a Bitcoin exchange that's based in London. They have since shut down, but they never had a breach of security and never had any money lost or stolen. And this was back in 2013. This was before Bitcoin had reached enterprise grade anywhere. Like, so I had to develop everything from scratch, made their vault storage software that was multi-signature back when no one was doing that. So very ahead of the curve. I'm pretty proud of that. Then fast forward, more recently, I was involved in a real estate partnership between 2022 and 2024 in Manchester. We had a community center building that the landlord wanted to sell it, and we weren't sure if the new landlord would still want that community center there. So we wanted to pool together resources within the community to buy the building. And the only real feasible way for us to raise the money for that was to tokenize it. And so this was actually kind of a crude proof of concept that tokenizing real estate can work, but it didn't have all the details fleshed out like I have done with Porcupine Properties here. So yeah, now today I am synergizing my experiences with software development, with Bitcoin, and with multi-party real estate investing to break new ground and push into the emerging world of tokenized investing. Next slide. Section 1. Next slide.
Next one.
All right, so Porcupine Properties LLC, it's a New Hampshire-based real estate holding company, a limited liability company here in New Hampshire. Its mission is to democratize access to real estate investing, to empower everyday individuals in New Hampshire to compete with corporate landlords, and to retain rental incomes within our local communities rather than exporting them out of state. It's essentially the same as a traditional real estate holding LLC that we've had for decades, but has one key difference, and that is that the ownership of the company is tokenized. So it's not exactly like we're tokenizing the property itself, like the real estate property. It's still a holding company that's an LLC. The LLC owns the property, and then the equity in the LLC is tokenized. It may be a distinction without a difference because it still ends up that each of the token holders has a claim on a piece of the property, but this fits more within the current legal framework. You know, the law and the courts understand how to handle a real estate holding company. So this is no different in that regard. The tokens that represent the ownership in the company, I like to view them as like a digital lever. So the ownership of the company is still recorded the way we've always done it, you know, on paper or electronic records. The company can file it with the state, Secretary of State. But now to move ownership of pieces of the company's equity between individuals, we can use token. So when you make a token transaction on the blockchain, basically that just triggers a legal transaction of ownership in the company from one party to another. So this is essentially a new model for record keeping. I think this goes exactly to something that Julie mentioned. This is a new model for record keeping and transfer mechanics only, and all the same tenant, landlord, and securities laws still apply because underlying this is still the same kind of company that we've had all along, just with a new digital lever to control the movement of ownership. So what are these tokens? Now, this is kind of interesting. I didn't previously know about Canton Network before I came here, but my technology and Canton Network actually could work together very well. I didn't know about Canton Network, so I didn't base my token on that network, but I very well could have. So this is not a competitor to that. This actually could run on Canton Network, interestingly enough. So Pine tokens, why did I choose to call them Pine? Well, it's the last syllable in porcupine. It's also, pine is a common residential building material, and it means to desire longingly. Tokens, the tokens are, like I mentioned, they're a digital manifestation of a record of ownership. And like I said, traditionally companies record their ownership information in internal records, and the stockholders are issued a paper certificate with a stamp and a seal and a signature on it. That is the stockholders' proof that they should be in the company's records. And the company can't just change the records to, exclude that stockholder. But of course, stock certificates are slow to move around. They can be forged. They can be lost. We can actually move the stock certificate onto a blockchain. That's what the tokens should be viewed as representing. They are a proxy for the stock, and they are a means for the stockholder to prove that they should be in the company's records as an owner of record. And yeah, so now with an open immutable ledger that anyone can review, we don't need the paper stock certificates anymore to prove ownership in the company. Now, there are a plethora of blockchains I could have used to implement this on, Canton being one of them. I chose the Liquid network. I'll give a little rundown of how Liquid works. It's not my core technology. So unlike Canton Network, I'm not presenting on the network itself, but I need to give you a little background on it just so you'll understand what I built on top of it. The Liquid network is a side chain of Bitcoin. It's a layer 2 on the Bitcoin network. It is a federated two-way peg, which means that Bitcoins on layer 0 or layer 1 can be pegged in to the side chain, at which point they're no longer usable temporarily on the layer 1, and they become Bitcoins on the layer 2, on the Liquid network. They're liquid Bitcoins. So they're still backed one-to-one by actual Bitcoins, and that backing is verifiable by anyone. Then you can use the layer 2 Bitcoins on the Liquid network, move them around. It's cheaper, it's faster than the layer 1. And when you want to move them back on layer 1, you can, because it's two-way. Federated means that there's a federation of verifiers similar to the Canton network. And these are pro-Bitcoin companies. They started out with 13 of them, but they introduced a technology they call dynamic federation, which is almost exactly what Canton was saying. There's a threshold that you have to meet to join as a new federation member. The same kind of idea. And they're the ones who hold the keys to allow the layer 2 Bitcoins to be moved back onto layer 1. Because of course, the layer 1 Bitcoins never disappeared, right? They were on layer 1 the whole time. They're sitting at a kind of a vault address. And in order to pull them out of the vault, you need the signature of a majority of the Federation members. One thing that Liquid Network does that Bitcoin doesn't is it supports native asset issuance, which means it's not just a single type of token that exists on that blockchain. And anyone can issue a token on the blockchain, on the Liquid Network blockchain. And the Liquid Network has confidential transactions by default. This is the technology developed several years ago by Gregory Maxwell and Adam Beck, also OG Bitcoiners from way back. Confidential transactions is kind of a combination of zero-knowledge proofs and homomorphic cryptography. What this means is you can, by default, all your transactions on the Liquid network are blinded, which means that a third party would be able to see that a transaction occurred, but not the amounts in the transaction or the asset types in the transaction. Only the sender and the receiver of each transaction would be able to see that information. However, everyone in the world, everyone who can see the ledger, can verify that no money was created or destroyed. So how this works, the homomorphic cryptography, basically, I'll try to boil it down real simple. It's as though you scrambled the numbers in a math problem such that the math still works, right? You have 2 + 3 = 5. Well, now you have some giant number that has no relation to 2 plus some other giant number that has no relation to 3 equals another third giant number that has no relation to 5, but the math problem works. This allows anyone to verify that the sum of all of the inputs to a transaction equals the sum of all the outputs to the transaction without knowing the actual amounts of those inputs and outputs. There's a blinding key that both the sender and the receiver have initially, but they can share with anyone that will allow anyone to actually decrypt those giant numbers back to 2 + 3 = 5. So this is how you can prove that you own a certain amount of the token. If you needed to, you could reveal your blinding key, and then anyone would see the actual amount that you received. I mentioned this is a merging of zero knowledge proofs and homomorphic cryptography. The zero knowledge proof, the reason that has to exist in the Liquid network confidential transactions is because otherwise, without knowing the exact values of the inputs and outputs, there could be negative values in there, right? You could have like 2 + -2 = 0, and we don't ever allow negative inputs and outputs, but you wouldn't be able to enforce that restriction if the numbers are all scrambled. So the zero knowledge proof, I don't know how this works. Unfortunately, I can't give you like a technical description of how it works, but it's called bullet proofs. And it's a fairly compact way of proving that one of these scrambled numbers is not actually a negative number without revealing what the number is. So it's zero knowledge in that way. All right, and then the last bullet point up there is the website for the company. This is a place where all the token holders can go and review their records, their capital accounts. Just like any LLC, you have a capital account, which gives the sum of all your contributions minus all your distributions. You can see your shares in the company. You can see your record of tokens, which normally will be the same as your shares because the tokens are supposed to represent the shares. But in certain cases, for instance, between the time that a dividend is distributed and the time that you actually receive your tokens, they may vary slightly.
Is it worth showing the website quickly?
I don't think so.
Okay.
You can also view because we'd have to log in to see any.
Oh, okay.
You can view your lots. This is the same as like any kind of investment platform. You need to be able to see, when you acquired each lot, and you can choose the order that you dispose of them for tax purposes. And you can view your dividends that you received. Now, the dividends are distributed also on the blockchain, on the Liquid network. Token holders can choose what form they want to receive their dividends in. They can choose a cryptocurrency like Bitcoin. They can choose a stable token like USDC, or they can choose more Pine token, which is equivalent to reinvesting dividends. The website also has the voting interface. Now, this will be more relevant for some companies than others. I guess I should say this technology is generally applicable, right? And I've applied it to a real estate holding company, but it could be applied to other companies. So the website has a voting interface where the token holders can choose, they can vote on matters of company governance, in particular, what to invest the company's capital in, whether to put the new roof on this year or next year, or buy a new property and so forth. Okay, next slide.
It looks kind of like a DAO.
AML compliance, yeah, not just by policy, but by technology too. This is really key. This is exciting to me. So I mentioned that Pine is issued on the Liquid network. Well, there's actually another layer in there called the asset management platform. This is a service provided by Blockstream. They're a Bitcoin company that's been around for a number of years. They built a service called AMP, Asset Management Platform, that's built on the Liquid network. And it introduces two new subclasses of assets on the Liquid network. There's issuer tracked and transfer restricted. So an ordinary Liquid asset that's any kind of token that's issued on the Liquid network is freely transferable. It works just like most stable coins that we know today, or Bitcoin, or most cryptocurrencies, in that you and only you have exclusive control to dispose of your tokens and send them to whomever you want. But that obviously doesn't work in the context of AML, KYC, sanctions, restrictions. We don't want to allow tokens to be sent to just anyone. We have to make sure that, one, we know whom they're being sent to, and that that person is actually allowed to hold them. So the issuer track tokens on the AMP are just what they sound like. It allows the issuer of the token to know who holds the token at any given time, so that they're not anonymous or even pseudonymous, but in fact can be tied to a physical individual. And then transfer restricted adds one more constraint on top of that, which is that the transfer of the tokens can actually be prevented if the transferee is someone we don't want to allow the tokens to be sent to. So that means that these tokens are not a bearer instrument, unlike Bitcoin and unlike USDC and stablecoins and most cryptocurrencies.
Well, none of them are bearer instruments.
Sorry,
Go ahead.
can you let him finish his presentation?
Yeah, I'm just saying, none of them are bearer instruments.
Well,
Go ahead, keep going.
please don't interrupt.
Yeah, that would be a good conversation for the end of this. And maybe I'm using the wrong term, but what I mean by that is the person who can prove that they hold the ownership of the token, regardless of who they are, is the person who has the right to whatever that token represents. That's not necessarily the case in the Liquid network on the asset management platform, because well, there's two things. One, you can have someone lose their wallet, and the tokens that were in that wallet have to be blacklisted so that they can be reissued to a new wallet, but the old ones can't be spent anymore. So, and actually, maybe that's all. I lost my train of thought. That question kind of threw me off, but sorry about that. Yeah, there's no anonymous ownership anyway. What I mean to say is that every token is held by someone that is known to the issuer. This allows us to enforce arbitrarily complex transfer rules preemptively. And this is what I think is really cool. So like traditionally, when you have a policy on who can transact and who can buy and sell an asset, if your policy is violated, you find that out after the fact, and then you go through the legal process of punishing, maybe reversing if you can. And so your punishment is a deterrent to breaking the policy. But what if you could prevent the policy from being broken in the first place, technologically? So you can with the asset management platform, because these transfer restricted assets, how this works basically is the platform AMP makes a call back to the issuer asking, here's a transaction that's been proposed. Should I let this through? Here's the details on the sender and the receiver. And the issuer can, look up those parties and say, yeah, that's fine, or no, don't let that transaction go through. And if they say no, it never even hits the blockchain because the platform doesn't provide the signature that's necessary. I kind of alluded to that. The AMP assets, tokens are always held at 2 of 2 multi-signature addresses. The token holder has one key and the platform has the other key. And what this means is that the token holder can't unilaterally send the tokens to another party. They always need a co-signature from the platform. That's what allows preventing policy violation, because we can tell the platform, don't sign that transaction, and then no valid transaction can even be created in the first place. So there's nothing to punish after the fact because it couldn't happen in the first place. So like some examples of some policies that I actually did implement for Porcupine properties. we can require that the recipient has gone through KYC and that we know their taxpayer identification number. That's important. If we're going to distribute dividends to them, you can't distribute dividends if you don't know who to report to the IRS. Another example, SEC registration. If you don't have an SEC registered security, then you're restricted to selling to only to within the state, right? So only to New Hampshire residents, for example, and then those purchasers can't sell to anyone outside the state for 6 months following the initial sale. And this can be enforced in the code so that they don't have to, even necessarily, they being the purchasers, the token holders, they don't have to know the identity of the person they're trying to send it to, because the platform won't let them send it to someone who is not allowed. Another example. So in New Hampshire, RSA 421B, for an unregistered security within the state of New Hampshire, the token holder can't sell to more than 5 distinct purchasers per year. So that kind of limit, a time-based limit, can also be and is implemented, to prevent those kinds of transactions from occurring. Okay, you can proceed.
You want to pause for questions here?
Sure. Yeah.
Okay.
But there was a question about I probably used the wrong term, but did you have a comment on that?
Do you want to comment on that? And
I made my comment. Sorry to
could you
interrupt.
state your name and
I'm Karen Parker Feld, Kensington, New Hampshire.
okay, and what was your comment again?
I'm saying that none of this is a bearer instrument. A bearer instrument means something that you can hold in your hand and present as payment. For all debts, public and private. Isn't that what it says on a cash note? It's a bearer instrument. That means that whoever bears the instrument is able to use that to pay anything they want to. None of what you're talking about here allows anonymity. Nothing.
Well, okay.
And anonymity is very important. I think it's important in New Hampshire. Because
So
let's say, let me just give you a use case.
you came in late and
I did.
we were talking about that. The previous presenter was talking about how to preserve your privacy. So you might go back and watch it.
Privacy is not the same thing as anonymity.
Thank you.
Thank you. I'm sorry I was late.
That's right.
I would
Let's
just
try to keep it on track.
counter to that I don't think that the current legal system would allow an anonymous owner of real estate. Like, we have to know who owns a building.
Yes. But I want to know,
Well,
can I anonymously give something?
I think that you would be able to anonymously donate your Pine tokens. The recipient wouldn't know who sent them.
Yeah, but somebody will know.
Oh, sure, right, of course.
Exactly.
The ownership of the tokens always has to be known by the issuer.
Exactly. I want to know, is there a way to anonymously give something? Completely
Yeah,
anonymously.
but not real estate.
But this is a very general conversation.
His presentation is about real estate, though.
Okay, sorry. Thank you.
All right.
Okay, continue.
Oh, I have to hit the next one.
I think somebody online has a question too, if we're paused.
Okay, yeah.
Jim.
Jim, you want to go?
Yeah, Jim Kish here. Hey, I have a question just to give some context here, from some technical context. Are you using smart contracts and oracles to do the work for administration that you're talking about?
I think that you could consider the callback to be an oracle, but the Liquid network doesn't support smart contracts in the way that like Ethereum would do. It's
Okay.
not a virtual machine. It's more similar to Bitcoin, just with this additional confidential layer.
Okay, got it. Because I'm just thinking about the administration layer as your network grows. There's a fair amount of administration in doing the validation work, between parties. Some of the things you're talking about, provisions that were in the contract, or in the agreement, or I think it was talking about the company could vote on, the holding company could vote on certain measures or matters, and then that there would be an administration that someone would have to be responsible for documenting, right?
Right. Yeah, the company would. And in fact, there's an API for retrieving a cryptographic verifiable proof of the votes. And this is another zero knowledge thing where you can prove that you voted, that your vote was included in the final count without revealing what you voted for.
Got it. Thank you.
Can I just interject? Your project is an example of a tokenizing real world assets. Like it's a startup. It's like a beginning of something new.
Right.
And this is a topic we're supposed to cover. So that's why I brought you in. It may be a little too technical for most of us. So if you could bring it around to how it could benefit New Hampshire,
Well, that's what this next slide is about. Community benefits. Yeah, tokenization that traditional finance can't match. So where this really shines, tokenizing real world assets, that's a tongue twister. It's when your assets are monolithic and difficult to divide. So it's relatively easy to tokenize something that is fine grained already. For instance, like stable coins. But when we're talking about something like real estate, where you typically don't have, I mean, you're not going to invest in a window or a door. You're going to invest in a whole lot with a building on it. And how do you break that into small pieces that are more easily, digestible, more easily chewable for the small time investor, rather than your wealthy individual or your corporation who can invest $1 million to buy a multifamily apartment building. So like I like to say, the tiny crumbs are more chewable than the whole cookie. And why I think this is great for the community. It allows the little guys in New Hampshire to compete with the corporate landlords from out of state. And like I said at the beginning, it's important to keep rent incomes within our local communities rather than exporting them out of the state or even out of the country. And if we have landlords who are local within New Hampshire, then the rents that are paid to those landlords will probably stay in New Hampshire. Yeah, so as an example, something that we can do that this divisibility allows us to unlock that is kind of really difficult or maybe unfeasible to do in the traditional world is a rent-to-own model for housing. It's never going to be as affordable as getting a mortgage, but a lot of people can't get a mortgage either because they have bad or no credit, or they don't have money for a down payment. In which case, rent-to-own is a possible path forward for them to actually own their home without needing to have that kind of credit that you would need to get a mortgage. How this would work, the tenant would live in a home that is tokenized through Porcupine Properties, and they would pay rent to the holding company. And the rent minus the expenses, the property expenses, that's property taxes and maintenance and everything, gets distributed to the token holders as dividends. And each month, in addition to the rent that the tenant is paying, they're also buying some quantity of tokens, as much as they can afford, hopefully. As they acquire more and more tokens, that now they'll start to receive a portion of the dividends that are being paid out from the rents. So effectively, they'll be paying rent to themselves, or some small portion of the rent that they're paying to the holding company will be coming back to them. And each month, they'll reinvest those dividends and also buy a little bit more tokens. And so the next month, their portion of the rent dividends will increase. And over time, eventually, over 30 years, they can acquire enough tokens that they can swap their tokens, just basically redeem them and then own the building outright. I have an example on the next slide, but don't go to it yet, of how this would compare numerically with a mortgage. But we can also look at this last bullet point. We can look at this from the other perspective. If you are a current property owner and you want to have some access to capital now, like you want to invest it elsewhere, or you want to do a capital improvement or whatever. Currently, you have the option to do a home equity line of credit or like a reverse mortgage. But this divisibility of of property, of real estate property, allows you to gradually divest from your ownership of that property. It's something that we don't normally see. Like when you sell a house, you sell the whole deed all at once. But when it's tokenized, you can sell it off piecemeal, you know, just a few tokens a week or whatever. So basically, it allows a property owner to trade some of their future rental income for present access to capital. And like I said, it's almost like a reverse mortgage, but there's no bank involved. And yeah, so in the end, the property owner doesn't own the property anymore, but also owes nothing. So I think that the revelation here is gradual transfer of assets, whether you're selling off a property gradually or you're acquiring a property gradually, something that you haven't really been able to feasibly do in the past. Right, so yeah, so we'll look at a case study here. These are just some example numbers. We'll start with a $300,000 home, and that's currently charging 10% per year in rent. So that's $2,500 a month. Maybe a little on the low side given current rent prices, but we'll take it as an example. And we'll assume that 30% of the rents are going to property expenses, you know, insurance, property tax, and maintenance, repairs, and everything. And 70%, the remaining 70% of the rents are being distributed as dividends. And the property, we're going to assume that the property appreciates by 4% per year, just for the sake of the example. And likewise, we'll assume that the rent increases by 4% each year. Okay, go for it. Now, I've got a lot of numbers on this slide, some of which we can't see because that video is in the way. Okay. Yeah, so we'll just go through this line by line. So what we're doing here on this table, we're comparing a 30-year mortgage with a 30-year rent-to-own scenario through Porcupine Properties. The property value line, the first line there, is showing the property value at the end of the year. You can see it's increasing, like I said, by 4% per year. So at the end of year one, that $300,000 property has gone up in value to $312,000. Then the second line, mortgage payments, you see it's always the same every year because this is a traditional mortgage. You might think that that number is a bit high, and it is, although it's not unprecedentedly high. I'll tell you what the actual interest rate on this example is at the end. It may not be as bad as you might think. The property value, I'm sorry, the property expenses line, we were assuming 30% of the rents were going to property expenses. So that is just what's reflected on that line. And then the Pine value year end, that is the value of the tenants' Pine tokens that they both purchased directly and that they reinvested at the throughout the year. And it also includes the appreciation on those tokens, because the tokens will appreciate because they represent the building itself. They appreciate at the same rate as the building does. Then the next line, the rent payments, we were assuming that the rent was 10% of the building's value each year. So the first year it's $30,000 worth of rent and so forth. And then additional Pine purchases, that's the amount of additional Pine that the tenant is purchasing in each month. And this is actually going down. You can see by the end, it's negative. I picked this number so that it would be an exact match with what they would be paying if they were buying with a mortgage. So you can see the mortgage payments plus property expenses. That's the same sum as rent payments plus additional Pine purchases. So we're doing an apples to apples comparison. In both methods, they're paying the same amount each month. And then the very bottom line, that's just the dividends that the token holder would be receiving and reinvesting. Just a second, I gotta catch up on my notes here. Right, yeah, so when that additional Pine purchases goes negative at some point, what it basically means is that the tenant is no longer reinvesting 100% of their dividends, but they're actually cashing out some of those dividends. So you can see that the additional Pine purchases negative on that last column there, year 30, negative 31,000. That's a portion of the 64,000 in dividends that they were paid out. And that, again, that's just to keep it in line with what they would be paying for a mortgage, because the mortgage doesn't change throughout the whole term. And yeah, at the end of year 30, you can see Pine value is just slightly more than the property value. So at that point, the token holder would be able to redeem their tokens and, get the building in their name. Yeah, so I told you I would tell you what the interest rate on this mortgage would have to be to make these two strategies, match in 30 years. It's 10.81%, which is high. But if it's someone who can't get a mortgage, a traditional mortgage any other way, this may be feasible for them. And also, of course, once they have enough equity built up, they could refinance out of this and go get a mortgage. So this is a way to get in the door. Okay. Yeah, so applications of the technology beyond real estate. Yeah, so like I said at the beginning, I applied this specifically to a real estate holding company, but my technology is general enough to be used for other purposes. In fact, the whole technology stack that I developed is clonable. I can, basically make a copy of the whole thing, give it a different domain name, issue new assets on the Liquid network, and use it for another purpose. So it could be equity in any company, or it could be bonds, if not just real estate holding companies, of course. And maybe the bonds could be corporate bonds. They could be municipal bonds, like, in New Hampshire, cities and towns. We can tokenize those. Typically, those kinds of bonds are traded in fairly, moderately sized chunks, but it may be still too much to be crumb size, right? Like if it's $1,000 chunk that you have to buy on a bond, maybe that's not something that an average investor could purchase every week with their paycheck. But if it's a $20 token, maybe they could do that. And also, I think maybe Keith, you could comment on this. Didn't the state of New Hampshire pass some kind of Bitcoin backed bond bill?
It wasn't a bill, it was it's a conduit bond through the BFA and
Oh, all right.
yeah, so it's not a municipal bond, but it's
Right. I know it's not a municipal bond, it's
Yeah.
some kind of state issue.
it's state, we can talk about it offline, but
Yeah. So I was thinking that also, it's backed by a token and it could also be tokenized itself.
oh shit, yeah.
Yeah. Okay. Actually, I had one more comment on this. Fungible tokens. So we had talked about earlier, car titles and property deeds being put on a blockchain. And Keith very correctly pointed out that you would issue non-fungible tokens to represent those things. That is the other side of the pie from what I'm talking about here. With my technology, this is strictly focused on fungible tokens. That is like all the shares of a company are interchangeable, they're fungible with each other. Versus, all the cars in the state are not fungible with each other. Okay, now you can go for it. All right, so legislative support needed to reduce friction. Yeah, so there is one issue that's kind of holding up my company from really being able to make a convincing sell, and that is the real estate transfer tax. The way it's currently, the way that the statute currently reads, I'll just read it. Transfers of interest in real estate holding companies, holding real estate, or holding interest in real estate, transfer of which would be taxable under this chapter if transferred directly, shall be taxable as transfers under this chapter to the extent of the fair market value of the real estate. The problem with this is it means that every time any token changes hands and triggers a transfer of interest in the real estate holding company, that would be taxable. And you can understand why they did it. I'm not like criticizing the way the tax is constructed, because you can tell that the legislators, when they crafted this statute, they were trying to prevent a kind of degenerate scenario where all the properties in the state would be held by holding companies, and then only ownership in the holding companies would change hands. And if they didn't tax that, then they would never see any property real estate transfer tax at all. So they put in this provision in the definition that if you sell interest in a real estate holding company, they're going to treat that the same as selling real estate itself for the purposes of the tax. If we actually paid tax on every token transfer, I think we would swamp the Department of Revenue Administration with forms, right? They'd get thousands of CD57 forms for tiny, tiny amounts, and they would hate it, and they wouldn't know what to do with it, and it would be a major headache for both them and for us. But also, there's no way to extract the amount of the tax from the token transactions. When a token holder makes a transaction on the asset management platform and we get a call back to ask, should this transaction be allowed? It's just a binary. It's yes or no, like yes, allow, or no, don't allow. We don't have the opportunity to modify the transaction to, take that 0.75% or 1.5% out of the amount that's being transferred. That would actually invalidate the signatures in the transaction. So it leaves us in a awkward position of how do we get the money to pay the transfer tax? Now, I have thought about this for a while to figure out if there's a way that we can fix this that doesn't eliminate the protection that's in the statute, that doesn't devolve into a situation where we have people dancing through holding companies to avoid the transfer tax. And I do think that I have a proposal that could fix it in the legislation, but I don't know if this is the right place to go into that proposal.
Briefly, because we're coming up on time, but
Yeah,
do you want to just touch on it? We can come back to it.
yeah. So it just centers around beneficial owners. If you know what that is from FinCEN, it just means like the physical natural person at the end of the stack of holding companies and corporations who actually benefits from the ownership in the company. So what I thought was maybe based on the beneficial owners before and after each transfer of interest in the holding company, we can determine whether that transfer should be taxable and to what extent. So I guess there are 3 rules. If both before and after a transfer of tokens, there are no beneficial owners in the holding company, that means no one has more than 25%, don't tax it. Because it just means that the material ownership of the company hasn't really changed. If there are beneficial owners, but at least there are beneficial owners both before and after, and at least one of the beneficial owners before and after is the same, then we also treat it as a no tax event. But if there are beneficial owners before and after, and there aren't any in common, then we tax the entire fair market value of the property, because we're just going to assume that in that case, it's a sea change of management. And even if there are some, minor investors who are coming along for the ride, we're going to say that that entire property has changed hands. And at that point, you do get a transfer tax.
But can I ask you a question? Could you just put it in like the fees? And then through your platform, you collect all the fees that then would go to revenue? Is there any fees for issuing the tokens and transferring the tokens?
There could be fees
incorporate
taken
that?
out of dividends. But what if you didn't hold a token long enough?
But that's what I'm saying, like, we're on this new future. Like,
Yeah.
do we have to change the way we're thinking the taxes go versus fees on some of these things?
Well, you would still have the issue that every time a token changes hands, it generates a taxable event. Right?
Correct, but what I'm saying is it just these minute little fees that you then collect, and at the end.
So you're saying like
Yeah.
accumulate them all,
Correct.
remit them all in one. Well, I think that would also be a way to address this, but it also requires a change.
Right.
Yeah. Okay. Cool. Yeah. So more questions?
Yeah.
I memean, I'm interested in New Hampshire's Dow LLC law, and, I'm just getting this now, so I don't know if you've thought about whether a Dow LLC is a useful statutory vehicle to accomplish some or all of the objectives you have here, or if the LLC form is fine. And I'm looking at what are the use cases for the Dow LLC as well.
Yeah, I'm wondering about that myself. Also, I started this before the Dow bill passed. I think that I haven't actually looked at the Dow bill, but I think that it's mostly a copy and paste of the LLC bill. Like everything that an LLC is, a Dow can be as well. And I also think that LLC, the structure of LLC.
A key, just so assume that a key legal difference is that with a Dow LLC, you don't need any humans running it. Whereas an LLC requires a member, at least a member, which is understood to be a person, which eventually you go all the way down. There has to be a human at the end of it. Whereas you could have an algorithm, pure algorithm, operating an LLC. If that is, does that enable things that you can't otherwise do?
Well, I think in the case of real estate, no, because unless we change New Hampshire statute to allow non-humans to own real property, At the end of the day, you're going to have human members of this company. So I think that everything that I wanted to achieve, I could do within the framework of the LLC. And also, I think, maybe Keith can correct me if I'm wrong, but I think the DAO structure, the DAO LLC requires the technology to be fully open sourced. And parts of this are open source, but I didn't want to open source the whole thing because that would just let someone else carbon copy it.
Yeah, that would be.
Well, the governance layer would have to be open source, but not necessarily. We can again pull it kind of offline.
Yeah, sure.
But I think it's interesting because as the DAO statutes develop, New Hampshire could also think about optimizing its DAO statute in the way that Delaware has, focused on its corporate law predominance by having excellent corporate law statutes. There are now 4 states that are kind of vying for that prominence. Wyoming is leading because of, I think, first mover advantage. And I think it'd be interesting to hear from practitioners and people in business what makes a law useful so that New Hampshire could potentially be an attractive state to incorporate or create a DAO. That'd be very cool.
Brandon. Hi, I'm Brandon. I'm from the Attorney General's office in the Consumer Protection Bureau. And this is a world that is becoming like increasingly familiar to me every time we meet, but it was like brand new to me when I started, so bear with me.
Cool.
But help me understand the rent to own model. So the first question, in your vision of this, do folks that are renting have the option to purely rent or to rent to own, or is it mandatory rent to own?
If you didn't buy any additional tokens and you didn't have any to begin with, then it would just be renting.
But that option would be allowed. Okay. And so for folks that are, decide, this rent to own path is something that's for me, is there like is there a mandatory amount that needs to be purchased on a monthly basis?
I mean, you could, of course, contract that as part of your lease, but no, not by the technology.
Well, so then how would like your average consumer that stumbles into one of these rental situations says, oh, rent to own, that sounds like something for me. I'd like to own some real estate. How do they make decisions about purchasing tokens and in what frequency to put them on a track to actual ownership?
I would assume that they would need to consult with a financial advisor. I mean, I wouldn't be in a position to give them advice.
Well, I mean, so this is sort of like what I honed in on, because if you're making statements like rent to own, you have to give consumers the ability to, they think that they're working towards ownership, and they have to actually be working towards ownership.
You can't be like 200 years out, right? They have to actually be on a track to own.
That's right. So that's just a concern that I dialed in on quickly. The consumer protection, that's part of my brain, which is a large part of my brain at this point.
Yeah.
But there have been problems with rent to own models, and that's one of them. Like you make a statement like rent to own, and then the terms by which the consumer actually needs to be on a path to own and how long it's going to take them to get there. That's something they need to be able to assess at the beginning to decide whether this is feasible or not for them. So
is there another aspect, like if you had a 30-unit apartment complex and I was living in one and I bought tokens for the whole complex, I'm not really owning my unit. I'm owning like a fraction of the total.
Right. It's not apportioned.
Is that wouldn't be rent to own because you're owning a piece of it, but not the whole thing.
You would never be able to buy just your own apartment unless it was a condo.
Unless it's condo. It's like a whole new.
Then you're
dynamic.
crossing into a whole new world of condominium law. You're like melting condominium law into rent law. Potentially, like this could get really scary. I'm just gonna. Yeah, now. I'm sure it's like, don't be less fun. We're gonna just go down a rabbit hole. I did.
It could enable people that can't afford a whole house to own a piece of it. The upside of it.
Or at least reduce their rent over time by having some dividends coming in.
can I ask one more question just to follow up? So the other piece that I don't fully understand is, assuming you have a consumer that comes in, they opt to take you up on your rent to own model. They talk to a financial advisor who says, all right, this is what you have to do every month for, let's say, 30 years.
Right.
They actually live there for 30 years. They make that requisite payment. You get to the 30-year mark. How would they effectuate actual ownership over this property at that point? Can you explain that?
Yeah, it would just be an ordinary property sale from the holding company to that tenant, except that the payment would be made in tokens rather than in dollars.
But is there discretion on part of the holding company as to whether they want
Whether they
to
want to
engage in
sell
that
it.
transaction at that point?
I mean, I would say yes, but I know that now your response is gonna be, if you marketed this as rent to own, you're required to.
That's right.
Right.
So I think that that is another problematic legal hurdle if you're.
I think it's problematic. I think it just needs to be written into the contract from the beginning.
Perhaps, but if there's any discretion though, when you got all the way to the end, and I mean, even staying in a rental property for 30 years and making those payments for 30 years, you know, people move around, so. But assuming somebody got there.
Right.
And said, all right, I'd like to cash in my tokens, I'd like to own this property outright, if there was any way to say, sorry, that would be a.
Yeah.
That would be a big
I
problem.
agree. And I think you would just handle that by having an option to buy it in the lease.
I think you would also need some protections in bankruptcy too. as well.
Yeah.
There's some-
Yeah, I
Contractual
have lots of
rights.
questions as a financial regulator, like listening to this conversation.
I'm sure.
Starting with, are any of the, you said it was a case study, is any of this actually happening, or is this more just like theoretical for the purposes of this presentation?
Theoretical.
Theoretical, okay. And then my question would be to, what does it look like when it goes bad with the rental case study? Because really, that's where the rubber meets the road. Have you created a de facto mortgage because you've been renting to own and they've like invested? Like, how does that look when you have to,
Bankruptcy.
or anything,
Or
like
they get
just,
evicted and
they-
what
yeah,
the
they
token's
stop-
worthless to them.
yeah,
There's a lot of.
there's a lot of,
I wouldn't say that the token is worthless to them because they'd still be receiving a dividend from it, assuming that the property can be filled with another tenant.
But then that tenant can't buy. the
they're,
other person's
yeah, so you have to
token.
cash out that person, right? Because you said they're creating equity, right? You said that. at one
Yeah, but they're creating equity in the holding company, not in that specific.
Okay. So
So assuming that the holding company holds multiple properties, there are enough tokens for the new tenants.
we can talk about it offline, but I've seen a
Sure.
lot of different variations of this model in my 14 years of the banking department, so I think I have a lot of,
Yeah,
I could ask you a lot of questions, but
yeah.
Because the only concern I have too is like you control the value of the token and the value of the property
Correct.
at the same time.
yeah,
Mhm.
and then
So,
how do you cash that out at the end? It's really a question of what happens when things go bad, right? It's all fine if you get to the end of 30 years and the worst problem you have is like mechanically, how do we transfer the title? Like that's the
Right.
best case scenario. And unfortunately, like that doesn't happen all the time, so,
That would not be the normal case.
yeah, so.
A Polymarket is introducing, tradable contracts in real estate values for different cities. And I'm just guessing, if tokenization goes forward on individual houses, then it's not gonna be too far down the line, there's gonna be trading contracts on the value of individual properties,
Okay.
right? I mean, do you agree?
I've never used Polymarket, but I think what you're saying sounds.
I mean, if they're creating tokens to buy and sell for people who can't afford, to live in San Francisco, whatever, you can now buy and sell tokens, investments, or bet on, sorry.
Right.
You could bet on the value of those properties. But once it's tokenized, it becomes, as you said, more fungible. I should use that word, but anyway, more
More
divisible.
liquid. Yeah.
Yeah, more divisible. So where does this whole thing go when we get to the point that, let's say, we're talking about like one apartment building or one house that someone's trying to buy their house. And there's a token and that token becomes tradable because essentially that's what we're talking about, right? The token is tradable.
Mhm.
And anyone can buy and sell a token. Even if they're not trying to own it.
Right.
But they need to be able to sell, like if someone has a set of token, they're moving out of town. And they need to have some value there, so someone else can buy and sell a token. Doesn't matter who lives in that building, someone else has an ownership interest,
Right.
right? So follow me here. And then we get to the point where if there are people already betting on the value of real estate in a given city. And then there's tokens for individual buildings in that city or houses.
Mhm.
That there's a whole landscape where people are betting on individual properties. I don't think that's a distant,
So betting is a whole other
Possibility.
layer on it, right?
Right, that's a derivative.
We're not talking about betting here.
no, I know you're
I know
not.
it's happening, yeah.
No, I know you're
The
not.
betting could happen regardless of. what the
Correct,
property's
correct. But it's easier to bet when there's an established token for a specific property.
All right, interesting question. I don't know the answer to that. Yeah.
What is the question?
Um, the question is, have any of you thought about that?
Just now for the first time. If
Well,
that-
you can go online, you can see that Polymarket has established vetting and they're creating indices for cities where you can buy and sell an index on a residential, area. And
Maybe,
now you're gonna tokenize houses, potentially. Potentially.
This is just a concept that we're
right,
giving.
I know, but I'm saying, once you follow it to its logical conclusion, this is not a 10-year event, this is a 5-year event.
Okay.
I think tokenizing real estate would probably make it easier for the index to compute the current value of real
Right.
estate because it would
Then
trade more
there's
often.
gonna be speculative bubbles and the people who actually live in those properties, may or may not be able to afford the speculative bubble that is falling down on them.
Yeah, with greater liquidity of, smaller, more divisible pieces of real estate, I could imagine bubbles could be inflated more quickly.
All right, we're getting up on time, so I want to wrap up here. Anybody online have any comments? We can't see you, so I haven't been able to. There we go. Any final comments? Katie, you probably
in their head. Oh, sorry.
had some thoughts about that last presentation, Katie, on the security side, maybe.
No specific comments. I am thinking about it though. It's very interesting.
All right, I'm sorry to cut this short.
I'm sorry to go over on time.
Yeah, that's all right. I just want to wrap up. I have the meeting scheduled in this space for the 10th next month. But I need to make it earlier in the day, if that's okay. Can everyone do 10 a.m. on March 10th in this room? If that works for the.
Does that work for the speakers too?
I don't know yet, but it's a
Well,
month out.
Yeah, we can change it.
And so for speakers, that, we have. I just had
Someone from January, right?
Bitco, I think is gonna come back.
Yeah.
They said that March would be a good time frame. I will double check that. And then my internet just stopped here.
CSBS, Conference of State Bank Supervisors.
Yes.
Yep.
And I have their names on the March. And that'll be interesting. That's more of a regulatory, less entrepreneur, more regulation.
Or more what other states are doing.
What else did you do? All right.
That works great for me. Thank you.
Is that okay, Jim? Okay.
Yeah.
And
Thank you.
Katie, does that work for you?
Yep, that'll work for me.
Just,
You'll make it work. Okay.
I may have to attend remotely.
Okay.
Yes, that's good. Good.
Yeah, more.
all right. I think we just had final comments. I can't pull up here again. It's funny. Alternative viewpoints, still looking for alternative viewpoints. Do you know any alternative viewpoints?
I have a few, but I'm gonna wait my turn.
Okay. You're gonna clean up.
Yeah,
All
yeah,
right.
pinch hitter.
Okay.
Closing act.
And then identifying areas of further research that we have not touched on, algorithmic stable coins. And I think that's something we definitely need to consider. I don't have a good technical expert on. So stable coins can be backed by real assets, or they can be calculated to algorithmically peg themselves to the price of a dollar. So they're constantly rebalancing, whatever. There's not even any assets back, but they're treated as if they're tied to the dollar. There have been some tales of woe in algorithmically backed stablecoins, and we kind of want to just.
I'm just not sure with the Genius Act, how much that's gonna happen. Sure.
Genius.
I think the Genius Act kind of closes that tighter.
Does it?
If I remember right, we can look at that.
So,
At least in terms of permitted ones that avoid securities, it completely cuts out algorithmic stablecoins completely as an option. It's completely non-option. They have to be backed one-to-one with.
So do we need to cover that space at all?
Well, I think it's relevant because the state could issue something that's not Genius compliant,
Oh,
one.
right, yeah.
And the other thing is like, there's still some argument around what exactly it means to have these like one-to-one reserves and in what form. So but I think basically it would be interesting to talk about algorithm, a non-Genius compliant product that state offers, like Wyoming is doing or North Dakota is doing. Those don't appear to be Genius sanctioned products.
I'll try to wrap that up as a topic in the future, not too distant future.
I was thinking too is just on that subject is that we could also expand it to just look at backing, what treasury versus deposits versus algorithmic. So it could be in this broader umbrella of just understanding the backing.
Yeah. But if anyone has any subject matter experts to point our way, please let me know.
Okay.
Can I ask a question?
Yeah.
When are you planning to prepare your report?
It's due November.
Are you gonna keep having hearings on different things, or once you've heard everything you need to hear, are you gonna start writing the report?
Probably the last 3 months, the report will be written, and then we'll talk about draft copies of it and then release it finally. But it'll be based on much of the testimony that we're hearing.
And will the public be able to participate in most of those sessions?
You could comment on the commission will vote on the final draft. And I imagine some abstentions with maybe your own comments at the end or however you'd like to do it. But so it'll be a majority of the commission approves it and then that'll become.
Right, but in the preparation, in the writing of it.
You could comment on drafts. So we'll have let's say 3 rounds of drafts that we can, 2 or 3, something like that.
And will that be an in-person meeting or sort of an email conversation?
We'll discuss it in public, but I guess there could be email conversations.
Okay.
You don't want
Oh,
to
the
run into right to know, you'll run into right to know problems.
Yes, okay, so
So all conversations that constitute a quorum of this commission will have to happen during a public.
Yeah.
So I was thinking one-on-one, like if she wanted to talk to you about it privately, right?
Sure.
Work out, like I have a problem with this piece or this is missing this.
Yep.
We could do one-on-one, but
No
we can't do it
problem
as a
there.
commission.
But if
Yeah.
quorum of the commission is
Yes.
communicating with one another outside of publicly announced meeting that complies with 91A.
You just can't have any conversations as a group
Right.
through email.
I was thinking more like one-on-one, as we're drafting. What did you have in mind? Did you?
You answered my question. I just, as I said last meeting, I'm very interested in the topic. It's so clear, all the advantages that you guys have been discussing. So when I say an alternative opinion, it's not like we shouldn't do this. It's more, let's understand the worst case scenario.
Okay.
Let's actually map out. It's important for something like this. Especially if it's gonna be adopted for the public. Speaking of tokenizing real estate, will there always be an opt-out? Where you don't have to have your property tokenized, for example,
Okay,
right? And things like that. So mapping out the worst case scenario, I mean, really putting your mind thinking about that. And then saying, well, no, this really wouldn't happen because we've got this protection in place and no, that can't happen because the technology wouldn't allow it to happen, something like that, I think is a good step before finalizing a draft.
I agree with everything you just said. I think that the best way for us to facilitate this and, you highlighted it, I raised it to you after the first meeting, is like, let's hear from the naysayers, let's hear from some of the concerns. That doesn't necessarily need to be in the form of a speaker that comes here and says, I'm an expert and here's my, naysayer, like Debbie Downer approach.
Exactly.
But if you have concerns or folks that have
Well, I
concerns,
would-
wait, hold on, let me finish.
Okay.
If you have concerns about anything that this commission is considering taking action on or implementing, recommending, you or anybody that who's involved in this space, write to the commission and express in writing, like, hey, this is something that I think you should consider, and these are some ways that I think you should consider. We're happy to do that. The chair just said, we're looking for ways to consider the naysayers, to consider the risks, to consider those things. And so the public is valuable in that space. So if you have public opinion you want to provide to the commission, we're happy to consider that during a public space, talk about how to best consider those concerns that you raised.
And it
But that's-
long before the report's being written.
That's right, but
Have
you
it
know,
better
if,
before.
if it's due in November and, you know, drafts are gonna start 3 months before, you know, you said you wanna wait your turn, I wouldn't wait, raise it now, while we have the time to have these meetings, and we have times to, you know, schedule follow-up meetings and things like that, because if you get too close to September, October, November, then we're already well into the
Yeah,
report.
we have to land the plane and do it safely, you know?
Yep.
All the minutes from all the meetings are online, so you could print them out and write your comments on them, write on the minutes, and that could be your submission, right? So, you know, we're trying to be as transparent as possible. This is a very niche topic, so it's not like, you know, the general public is even interested in it, but I think it's gonna have implications for the regular folk down the line.
And along those lines, there are states that are passed bills that you have to still accept cash.
Yeah,
And there's stuff like that. So maybe that's the other thing too, is like that balanced approach, like, you know, because that's a concern even before tokenization and stablecoin is people still want to be able to use cash.
Mhm.
And some states have passed laws with that. So, that's, you know, maybe we could, you know, have that.
Well, I appreciate all that. And definitely I will follow up, in that regard. But, if I were in your seats, I would be asking myself, what is the worst case scenario of what we're planning here? Not the best case. Because we've already had, you know, multiple substantial financial crises because of derivatives and assets that have been rehypothecated so many, they basically become Ponzi schemes.
Yeah.
Okay, so that is the most important question. Now, if someone owns a home, they own their home. But if there are tokens and people are buying and selling tokens and they're doing derivative transactions on tokens, you know, where does that go? That's all I'm saying.
Yep.
So you don't need me to tell you the questions you should be asking yourself, but I am telling you the questions you should be asking yourself. And I will, you know, I will formulate, maybe what I'll do is I'll just bring a list of questions.
Okay.
And in my opinion, I would like us to get done with this overview introduction phase by May. Because I don't know how easy it's gonna be meet during the summer. So this
Yeah.
way, everyone gets all their facts in and then, you know.
We got a
use
month
the
or two,
AI
yeah.
Report and just do that. Like,
Right.
we literally have 3 more presentations and that's it. You know,
So we have a couple of invites out there that I need to, you know, keep my word on. And then once we get to the end of that,
Yeah.
and May is definitely probably the latest. All right, so we're running late. I have to be at an event. So I'm gonna call the meeting to a close. I don't think we need to
make a
vote.
motion.
You have to make a motion.
Okay.
All in favor of adjourning?
Aye.
Say aye.
Bye.
All right, any opposed to adjourning? All right, here we go.
Stop the recording. Good.
Sorry for being late.
No problem.
Disruptive a little bit.